Please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Tax planning, friends, I want to share with you some ideas out of the box. Succession planning is even going to be a bigger eye-opener. And when I talk of tax planning, I think first and foremost you need to understand very well what are the exemptions and the concessions under the Indian Income Tax Act and how you can balance and fine-tune them with the tax system in your home country. You know, we have friends, NRIs living in 130 countries. As Shantanu mentioned, Shantanu, I have had the privilege of studying most of the major tax systems. But let me tell you, your entire NRI ball game in terms of trying to be able to be of assistance to them would be half-hearted if you are not able to align, your tax planning strategies from the Indian context to the home country regulations where the NRI hails from. Say for example, if somebody is located in Japan and he is in the top tax brackets, there are still those countries which have tax rates beyond 50%. In Europe, you go to some of the Northern Europe countries and you have tax rates which are beyond 60%. Even in the United States of America, where the federal tax rates are not that high, but when combined with the state tax rates, there are states in the United States where in the top tax brackets you could easily get into the 50% plus. So when you are talking of investments in these deposits or other investments, you have to do the tightrope walking of trying to balance. But let me tell you, any day, your NRE, FCNR deposits, they are solid gold. And not only, in terms of the returns that you can possibly get with all the safety aligned with it, but even in terms of tax and investment planning strategies, and all the regulations connected with remittances and repatriations, they are extremely useful tools. And therefore, I am glad, Manish Bhai, you put it into a focus which our NRI friends listening to this webinar need to understand. Why are NRE and FCNR deposits so popular? Obviously, as was mentioned, they enjoy complete tax exemption under the Indian tax laws. And particularly for those NRIs, and they are not in a small number, who live in countries where there is virtually no income tax or where the income tax rates are very low, I think it's a great win-win situation. And as you mentioned, Manish Bhai, FCNR, just imagine if in 72 it was 5 rupees to a dollar and today we almost touch 80. Even if you had done nothing, even if you had put it at a zero tax return, the FCNR deposit itself would have been gold. So there are people who value this deposit even with its low interest tax rates, in the fluctuating forex regime. So anyway, so 10.4 and 10.15 F4A. Now here, I'm just trying to point out some finer aspects. One of the points that came up during the COVID regime was there were a good number of NRIs who were for some reason stuck up in India, not just for 1 but for 2 years. And what happened is they became, by virtue of their 182 days plus stay, as residents under the Income Tax Act. And their concern was what would happen to the taxability of the deposits, which are in the NRI account. These kind of concerns arise, and therefore I want to point out a very interesting thing which itself can go into strategic tax planning, that section 10(4) interestingly talks about the exemption for interest on NRE deposit in case of a non-resident, but not a non-resident under the Income Tax Act, a non-resident under FEMA, the Foreign Exchange Management Act. And friends, as an NRI, you need to understand the distinction and difference between an NRI that is a non-resident under the Income Tax Act, which is strictly based on physical stay and other conditions, and non-resident under FEMA, which is linked with your intention. If, for example, during these years, even if you have stayed in India for a full year or maybe more, but if your intentions have always been to be there in your home country, for all practical purposes you will enjoy the exemption in respect of your NRE interest. Coming to FCNR, again, it is obviously, the exemption not just in the case of a non-resident under section 6 of the Income Tax Act, but also in a case of a resident but not ordinarily resident. Now this finer aspect can go to help not only in these situations where you are stuck up in India for reasons beyond your control, but also when you plan to return back to India, and as you know, you can easily plan a status of R but NOR on your return and continue to enjoy the benefit even while you are a tax resident in India. So these are some finer aspects of the exemptions. But the lesser known facts and the star benefits, I would say, are in respect of the concessional tax regime under what we call as Chapter 12A of the Income Tax Act. Now this Chapter 12A, which deals with sections 115C onwards, was a chapter which was introduced, I recall, by the then Finance Minister and who later on also became the President of India, Shri Pranab Mukherjee. And this was a big stimulus, a turning point for a very long time. Of course, in between, when there was a total exemption in respect of the long-term capital gains and dividend income, this chapter, which deals with some special provisions in relation to investment income, became a little lackluster. But I would say in the past 2 years once again, in fact from 18 and 20, since LTCG and dividend have become taxable, this chapter has become extremely important for NRIs. Let me just, within the constraints of time also, make a mention of 3 specific provisions. We have a provision what we call as under section 115D, which says that in respect of investment income, and what is investment income? Investment income is out of specified foreign exchange assets. Now, what are forex assets which are there, in convertible foreign exchange, which were originated from any remittances outside India or even from NRO to NRE conversions? As you know, now under the $1 million rule, there is a huge amount of potential planning that you can look at. So what happens is, if these funds are parked into the specified assets which include shares and debentures of any company other than a private company. So it can be either a closely held, in fact, as far as company closely held company, shares can be even of a private company, but deposits and debentures would be of a public company which could be closely held or listed. So shares of any company, debentures and deposits. And the good news is that it is almost a settled judicial position that bank deposits will be equated or treated as deposits with Indian companies, because the ruling has been that banks are also Indian companies, and therefore when you place a deposit with a bank, you can get the benefit of that. I'll come to some specific strategic planning a little later, but just to explain to you, 115D talks about a flat rate of 20% if you opt for that. That is 115D. And I repeat, the incomes that would be covered would be your dividend from any shares of a private or a public, listed or closely held company. It would be debentures or deposits of any public company, closely held or listed, or it could be even government securities. Now let me give a specific example. As you are aware, dividend is now taxable. If you are getting a large amount, as an NRI, if you have invested in a large chunk of shares and you are getting a large amount of dividend from any private or public company, as you are aware, friends, 15 lakhs and above, you start from 31.2% bracket. And of course, there is a little relief in terms of surcharge, but still you could go, if not to 43%, which could be there in case of interest. But even if you get the benefit of a concessional surcharge which is specially provided for dividend and capital gains, still you could get into a 34.32% tax bracket. Now compare even with the rate of a surcharge on that 20%, you would be at a 22.88% as compared to a 34.32%. And you don't mind the flat rate, because beyond 15 lakhs, the rate is flat in any case. So what happens? You get a tax arbitrage of something around 8% easily, even in case of dividend income. And if you are talking of, say, interest, it could be, if income is more than 5 crores, it could go up to 43, and you are talking of anything, which would be max, say 28. So there would still be a 15% tax arbitrage in terms of the difference. So there is a huge potential of looking at this specific provision of 115D. There is another, I would say, practically unnoticed kind of a provision in section 115H, which is in respect of long-term capital gains arising out of any such specified foreign exchange assets. Say for example, from any part of the world you had invested, say in a startup here in India, in a company where you would have, say, put in shares of $1 million. And today the startup is fetching you if you offload these shares, even of the private company, something around $5 million. In this case, the $4 million would otherwise, even in the case of a resident Indian, it would have attracted a tax of, close to 24%, even with the concessional surcharge that was announced in the last budget. And think of it, if you are told that you can plan to pay zero tax, irrespective of the amount of gain that you derive, long-term capital gain from any private or public listed shares. If they were listed shares on which you are paying STT, the rate of tax long-term would be 10% plus the surcharge and cess. But in case of a private company, it could be 20% and surcharge cess. Now just imagine if you were to enjoy this total tax holiday, if the investment was made. All these benefits which you enjoy in India, you have to ensure that you are correspondingly in a tax regime which is also tax friendly. Because if you do planning in India and you have to pay there, it leads you nowhere. So you have to do this tightrope walking, as I said. But this section 115H is something which you need to very close. 115F is what you very closely need to look at, because it gives you this total exemption from capital gains, and the only condition is that within a period of 6 months, whatever is the gain out of any of these, you can reinvest in any other asset. So for the KOTAK team, it could be investment arising out of the consideration arising out of sale of shares, and if somebody wants to straight away put this in a NRE or FCNR deposit, he pays zero tax, even if he does not want to do another investment in shares, because the same forex assets would be there. I just took a little more time on this because I felt I needed to sensitize so many friends about this lesser known provision under the Income Tax Act. And an equally attractive provision is under 115H. That is particularly very attractive for all returning Indians. Because returning Indians, and I have seen cases, Manish Bhai, that you can take the shelter of that special 20% flat rate, for interest or whatever, dividend, etc., that you want to take as investment income. Under this section, before returning to India, making your investment and continuing with that investment, because the only rider is that as long as you don't make any transfer or conversion of that particular deposit, you can continue. So there is a great opportunity even on this front, if you are looking in terms of tax planning. Many a times, it becomes worthwhile not just to look at the conventional investments like simple bank deposits. Because what do in a bank deposit? You get interest, you pay tax on that interest, and obviously, you are at that level, you don't even need all that money. So you want to reinvest. So you are getting some return and reinvesting it, depleting the value of your investment by the tax that you are paying. Now, why would you want to do that? Would you not be smart enough in looking at investments which are in the nature of growth-oriented investments? Because it's a win-win situation both in India as well as in your home country. Be very clear, there is not one tax system in the world which says that unless and until you have liquidated something and got actually in your hands in terms of return, either as interest, dividend or capital gains, you have to pay tax just on the illusory growth. Of course, you have to be sure that your growth is going on the growth path and does not get into the degrowth. But growth-oriented investments is one of the great strategies as far as tax planning is concerned. And as I said, what is nectar for somebody may be poison for the other. If you are in Middle East or you are in the Southeast Asia, where there is zero tax or the tax rates are relatively very low, you can have a completely different investment pattern. But if you are in those territories where there are high tax rates, because gone are the days where you could play hide and seek with the taxman, either in India or abroad. The G20, as we know, was essentially formed for this reason, to ensure that this treaty shopping which was being done does not survive. And therefore, if you are in the US, you have the F-bar and you have the Fatka here in India corresponding. If you are in India and you are having overseas investments in your ITRs, you have scheduled FAs and you have things to declare. Even for NRIs, when they file their tax returns, there was a time when nobody used to bother asking what was your status, in the sense how many days you were in India, or if you were an NRI, what was your social security number or your tax ID. But today, be it India, be it US, be it whatever part of the world, the sensitivity is so high that the traffic cameras are capturing, your activities. So please understand, when we talk of tax and investment planning, it has to be in consonance, and you have to ensure that you align it with the times and the tides, that are there in terms of the prevailing tax systems around the world.